Welcome to the Deep Dive. Today we are taking a scalpel to the Q3 2025 earnings conference call for Pixelworks Inc., ticker PXLW. And this was not your standard quarterly call, not at all. This was really a strategic roadmap, all delivered after the market closed on November 11th.
That's exactly right. And you have to start there. We're not just looking at a P&L statement here. We're really dissecting a company in the middle of a radical self-surgery. Management is executing this massive pivot, shedding its traditional semiconductor business to become, a pure-play IP licensing company.
So the numbers only really make sense through that lens.
Only through that lens.
Okay, let's start unpacking this, beginning with the raw data. The results were, well, undeniably mixed.
A mixed bag for sure.
Yeah, which explains the market reaction. It was just this modest bounce after hours. It felt more like relief than real enthusiasm.
Right. So on the top line, revenue came in at $8.8 million, which was actually a slight miss.
A miss against the, $9 million consensus?
Exactly. And that's down about 8% year over year. But to their credit, it did show sequential growth, up 6% from last quarter.
So there's some stabilization there.
A little bit, yeah. But the real surprise, the positive one, was on the bottom line.
Right, the non-GAAP EPS. And we should probably stress non-GAAP means they're excluding all these one-time costs tied to the pivot.
A lot of restructuring charges in there, yeah. So the loss was negative 69 cents. And that just crushed the consensus estimate of a 92-cent loss.
That's a 25% positive surprise. That's huge.
It is, and it shows they're really managing the parts of the business they can actually control. Which leads right to the main highlight for me, the gross margin.
Okay.
Non-GAAP gross margin shot up to 49.9%.
Almost 50%. That's a substantial move.
It's a huge jump. That's an improvement of about 400 basis points quarter over quarter.
So a 4% jump in just 3 months?
Yeah. And that's proof that the product mix, leaning more towards their high margin IP combined with those restructuring benefits, it's all finally hitting the income statement. This wasn't an accident.
Management engineered this. And that engineering takes us right into the cost discipline. The financials really show an aggressive approach here.
Oh, absolutely. The overhaul of their operating structure has been dramatic. Non-GAAP OPEX down to $9.2 million.
Which is a drop of what, year over year?
It's down $3.1 million. I mean, that's a huge reduction. This is where the cost cutting really, really shows up.
I was struck by the cash burn. They cut their cash burn from operations by over 60%.
60%.
Year over year, it's under $3 million for the quarter. For a company going through this much upheaval, that is a monumental effort.
It buys them time. It buys them a critical runway. And if you look at their liquidity, they had about $22 million in cash at the end of October.
And that wasn't an accident either.
No, they were stocking the shelves with cash. They did a $3 million patent sale and then raised about $6.5 million net from a direct equity offering.
All before they unveiled the main event.
Which is, of course, the massive and very complex Shanghai subsidiary sale.
This is the whole reason this call was so important.
It's the centerpiece. So on October 15th, they signed a definitive agreement to sell their majority stake, 78% ownership in their Shanghai subsidiary.
And this is basically where all the old chip business lives, right? All the people, the operation.
That's the legacy business. And the buyer is an entity led by VeriSilicon,
which is a major Chinese semiconductor IP player. So it's a strategic move for them. And for Pixelworks, the proceeds, they're expecting $50 to $60 million in net cash.
Which is a transformational amount of cash for them right now. The CEO laid out the rationale in sort of 3 pillars. 1, unlock and repatriate value. Getting cash out of China is incredibly hard right now. 2, sharpen their focus on their core IP, which is TrueCut. And 3, and this is maybe the most important, de-risk the balance sheet.
Okay, we have to talk about the valuation complexity here because I know the analysts were all over this. The entity was valued at $133 million, but Pixelworks only expects to see 50 to 60 of that. Why the huge haircut?
It's a crucial point, and it's all about legacy shareholders. Even though PXLW owns 78%, the U.S. parent company is on the hook to redeem the minority shareholders.
And some of them invested at much higher valuations, right?
Much higher. Some of those late-stage funding rounds valued the subsidiary at over $500 million. It's staggering.
So the U.S. parent is basically paying a premium to clear out all that financial baggage before the sale goes through.
Precisely. They're using a big chunk of their ownership value just to clean up the cap table. You factor that in, plus, an estimated 10% withholding tax to get the cash out of China, and you land right in that $50 to $60 million range.
It's an expensive cleanup but a necessary one to get the deal done.
Seems so.
And we can't ignore the geopolitical context here. Management was surprisingly candid about it.
They really were. They explicitly cited escalating geopolitical tensions. They even talked about an undercurrent of what they called delete America sentiment in China's semiconductor market.
Wow.
Yeah. So over the last 18 months, it just got harder and harder for a U.S. company to operate there, to compete, to win contracts. So the sale becomes less about optimization and more about, well, survival.
De-risking the entire business model.
Exactly.
So if the old chip business is gone, what does the new Pixelworks even look like?
The vision is an asset-light, low headcount, pure play technology licensing company, all focused on cinematic visualization. The future is 100% TrueCut Motion IP.
And they were very clear. PXLW retains 100% ownership of TrueCut. That's the crown jewel now.
It has to be.
Let's take a second, though, and define TrueCut. What does this tech actually do?
So TrueCut is a pretty powerful tool. It's a grading and motion management solution. It's designed to solve that problem you see in high frame rate movies. Motion blur, or that weird jittery look on digital screens.
Yeah, that sort of soap opera effect.
Exactly. TrueCut lets filmmakers and studios control precisely how motion looks on screen. It ensures that what they imagined is what you see in the theater and eventually on devices at home.
And it is showing real traction. This isn't just a theory anymore.
No, it's validated. It was in 3 new theatrical releases in Q3. We're talking Universal's Jurassic World Rebirth, DreamWorks' The Bad Guys 2.
And it's confirmed for Wicked for Good later this month.
Right. But for the company to succeed, it has to be more than just a few movies a year. It has to scale.
Which brings us to the big growth catalyst they hinted at, the strategic ecosystem partner.
This is the linchpin of the entire turnaround story. Management said they're getting close to a deal with a major partner.
And the goal here is to get TrueCut onto consumer devices,
Right.
Into the home.
That's the whole game. Think smart TVs, streaming boxes, the big platforms. One deal like that could accelerate device licensing revenue globally and change TrueCut from a sporadic, project-based income into a recurring, high-margin licensing model.
Okay, let's talk about guidance. They didn't give any for Q4.
Which is totally reasonable, I think. Once the Shanghai deal closes, their financials are going to look completely different. You'll have continuing ops for the licensing business and discontinued ops for the chip business.
Any guidance they gave now would be obsolete in a few months.
Exactly. It would just create confusion. So they chose to wait.
But the analysts still pressed them pretty hard on the call, right? Especially given how much the stock dropped after the sale was announced. They were basically asking, is $50 million really worth giving up your main revenue stream?
Oh, yeah, that was the big challenge. And management had to just reiterate their argument. The chip business was high risk, capital intensive, and was being strangled by geopolitics. They're sacrificing that near-term revenue for what they believe is a much more scalable, high-mission future.
And we have to remember, this all still requires a shareholder vote.
A vital hurdle. They need 67% approval. Until that happens and the cash is in the bank, this pivot is not a done deal.
Okay, let's zoom out. Let's put PXLW in the context of the broader semiconductor sector.
I mean, the divergence is just staggering. The SOXX, the main semiconductor index, is up over 35% in the last year.
And Pixelworks.
Down about 38%. So this isn't a sector problem. This is entirely a stock-specific story driven by dilution and all this strategic uncertainty we're talking about.
And October was brutal. 2 big events really caused that repricing.
Brutal. First, the equity raise, which created dilution concerns. But the killer was the Shanghai sale announcement on October 15th. The stock dropped 48% almost overnight.
Wow.
The market just violently repriced the company from a complex chip maker down to a much smaller pre-revenue licensing company.
So investor sentiment is on a knife's edge. The cost control is great, but the market is just waiting.
Waiting for execution. They need 2 things. 1, the deal has to close. The cash has to hit the bank account. And 2, they need concrete proof that TrueCut can actually become a real durable business.
Right. Management bought themselves a runway. Now they have to prove they can take off.
That's the whole story.
Okay, let's shift gears. Time for our segment where we look at potential market implications.
Yeah.
And let's be crystal clear. Nothing we are about to say is financial advice. Don't take it as a recommendation to buy or sell anything. We're just analyzing this wild strategic shift and pitching an outrageous but plausible trade idea.
And the starting point for this idea is that the stock is still valued like it's a broken chip company. That 50 to 60 million in cash that's coming, That is a massive amount relative to its current market cap. It's just dry powder.
So what's the trade? The highly conditional trade.
This is a risk arbitrage/turnaround play.
Yeah.
And it is completely contingent on two big announcements happening close together.
Okay, what are they?
The entry point is to go long PXLW only on the official announcement that the Shanghai deal has closed, and when they officially reinitiate guidance for the pure play licensing business. But the trade only works if TrueCut shows immediate scale.
So it's a bet that this hinted at strategic partner is a really big name, a blue chip company.
It has to be. We're speculating here, but you're talking about a major global player, a top-tier TV maker like a Samsung or an LG, or maybe a huge streaming platform like a Netflix or Disney+.
And if that happens, it instantly validates the whole model.
It changes the entire narrative. The trade is a bet that the combination of that massive cash infusion plus officially taking the China risk off the table, plus that one big partnership, it pushes the stock way past its 52-week midpoint. Very fast.
So it's a shift from survival mode straight to focused growth story.
Exactly. It's high risk, a total bet on execution. But the idea is the market hasn't priced in what that company could do with a clean balance sheet and a singular aggressive focus on IP.
That is a bold pitch. So, to wrap up, the key takeaway is clear. Pixelworks is pulling off this massive transition. They're becoming leaner, they're IP-focused, they're de-risking. But everything now rests on TrueCut Motion's ability to actually make money.
And that leads to the final provocative thought for you, our listener, to think about. Does that $50 to $60 million cash buffer just buy Pixelworks time to tread water? Or does that cash genuinely enable the kind of rapid, focused growth that's needed to justify the massive derating the stock just went through? The answer to that will tell you everything.
A fantastic question to end on. Thanks for joining us for this deep dive into Pixelworks. We'll catch you next time.